Picture this. Warren Buffett is sitting at the annual Berkshire Hathaway shareholder meeting. Thousands of investors watching, cameras rolling, the most important investment conference in the world. Buffett finishes a brilliant answer. Everyone turns to Charlie Munger, his partner of over 50 years. And Charlie just leans into the mic and says, "I have nothing to add." The crowd laughs every single time. But here's what nobody tells you. In those 4 words, Charlie Munger communicated something most investors spend a lifetime trying to learn. The power of knowing when not to act, not to speak, not to buy. That one phrase, that is the mental model. Today, we're going inside the mind of Charlie Munger, the man who turned $2 billion worth of thinking into one of the most extraordinary investment records in history. Not with luck, not with insider tips, but with something far more powerful. A latticework of mental models that let him see the world differently than everyone else. Stay with me, because by the end of this video, you're going to think differently too. Charlie Munger was born in Omaha, Nebraska in 1924. He grew up during the Great Depression, watching his family, his community, struggle through poverty. He worked in Buffett's grandfather's grocery store as a teenager. Warren Buffett worked there too, though they hadn't met yet. Munger studied mathematics, then meteorology during World War II, then law at Harvard, never once earning an undergraduate degree. He was a lawyer before he was an investor. And yet, this man, without a finance degree, without a Wall Street pedigree, went on to become vice chairman of Berkshire Hathaway, helping Buffett grow it from a struggling textile company into a $700 billion empire. How? Not through connections, not through luck, through a ruthlessly disciplined way of thinking, one he built deliberately over decades by reading voraciously across every discipline imaginable. He called it his latticework of mental models, and it changed everything. Before we dive in, let's make sure we're on the same page, because the term mental model gets thrown around a lot, but very few people actually explain what it means. A mental model is simply a way of understanding how something works. It's a framework, a lens, a shortcut for thinking. We all use mental models every day without realizing it. When you check the weather before leaving the house, that's a model. When you estimate how long a journey will take, that's a model. But most of us only have a handful, and we use the same few over and over again, even when they don't apply. Munger's insight was radical. He said the best thinkers aren't specialists. They're generalists who borrow the most powerful ideas from every field: physics, biology, psychology, economics, history, and use them together. He called this a latticework because the models connect and reinforce each other. The more you have, the stronger your thinking becomes. Here's a question Munger loved to ask. All I want to know is where I'm going to die, so I'll never go there. Morbid? Yes. Brilliant? Absolutely. This is the mental model of inversion, and it's arguably Munger's favorite. Most of us think about problems forward. We ask, how do I succeed? Munger flipped it. He asked, how do I avoid failure? Instead of asking, how do I build a great business? He asked, what would destroy a great business? Then he made sure to avoid those things. Instead of asking, how do I become wealthy? He asked, what behaviors make people poor? Then he consciously avoided them. Debt, impatience, envy, speculation. It sounds simple. It is not. Inversion forces you to challenge your assumptions. It uncovers blind spots that forward thinking misses completely. Mathematicians have known this for centuries. Brilliant architects design buildings by first thinking about what would make them collapse. Now you know it too. Next time you face a problem, flip it. Ask what you're trying to avoid. The answer will surprise you. Munger didn't just collect mental models. He built a system. He read voraciously, not just finance books, but physics, biology, history, psychology, mathematics. He once said, "I have never met a wise person who doesn't read a lot." And he wasn't reading to memorize facts. He was reading to extract the fundamental principles, the bedrock ideas that explain how the world actually works underneath the surface. He called the great ideas from each discipline the big ideas. Physics gives us models like gravity and thermodynamics. Biology gives us natural selection. Psychology gives us cognitive biases. Economics gives us supply and demand. Here's the key insight. When multiple mental models point to the same conclusion, that's when you can be confident. He called it confluence, when the evidence converges from multiple independent angles. Most investors make decisions based on one lens. Munger used 10, 20, sometimes more. That's not overcomplicating it. That's how reality actually works. And when you start seeing through multiple lenses at once, everything changes. Here's a question. Would you rather be a genius who doesn't know their limits, or an average person who does? Munger and Buffett chose the second option, every single time. They called it the circle of competence. The idea is this. You have areas where you genuinely understand what's happening, industries you've studied deeply, businesses you can evaluate with confidence. That's your circle. Everything outside that circle, you don't truly understand it, no matter how confident you feel. The secret isn't the size of your circle. It's knowing exactly where the boundary is. Munger was brutally honest about what he didn't understand. When the technology boom of the late 1990s sent investors rushing into dot-com stocks, Buffett and Munger stayed out. Critics called them dinosaurs, old-fashioned, out of touch. Then the bubble burst, and Berkshire was fine. They didn't lose because they never bought what they couldn't understand. The lesson isn't to stay small. It's to be honest, know your edge, work within it, and slowly, deliberately expand it. This is one of Munger's original contributions to the world of thinking, and it's one of the most powerful and most dangerous forces in human behavior. He called it the Lollapalooza Effect. It's what happens when multiple biases, incentives, and social forces all point in the same direction at the same time. On their own, each force is manageable. You can see it, account for it, resist it. But when 4, 5, 6 of them stack on top of each other, the result is an explosion, something far more powerful than the sum of its parts. Think about the 2008 financial crisis. On its own, low interest rates aren't catastrophic. On their own, poor lending standards aren't catastrophic. Overconfident investors, flawed ratings, political pressure to increase homeownership, each alone is a problem. Together, they created the worst financial disaster in decades. Munger studied this in reverse, too. The greatest businesses in the world, like Coca-Cola, which he and Buffett invested in heavily, benefit from Lollapalooza effects. Brand loyalty, distribution advantages, habit formation, social proof, all stacking together. When you see forces stacking, pay attention. It could be the best opportunity or the greatest danger of your financial life. "Show me the incentive," Munger famously said, "and I'll show you the outcome." He believed this was the most underappreciated principle in all of human behavior. And he was right. People do not act on logic. They do not act on good intentions. They act on incentives, often without even realizing it. Think about it. Why do pharmaceutical companies sometimes push drugs that don't work? Incentives. Why do financial advisors sometimes recommend products that aren't in your best interest? Incentives. This isn't cynicism. It's clarity. Munger applied this to investing constantly. Before buying a business, he would study the incentive structure. How are the managers paid? What behavior does that reward? Are the interests of management aligned with shareholders or in conflict? He also applied it personally. He structured his own life to align his incentives with his values. He invested his own money alongside clients. He tied his compensation to long-term results. Want to predict someone's behavior? Don't listen to what they say. Look at what they're rewarded for. Here's one of the most uncomfortable truths in the world of investing and in life. The smarter you are, the better you are at fooling yourself. This is what Munger called confirmation bias on steroids. Intelligent, educated people are extraordinarily skilled at finding reasons to believe what they already want to believe. They can construct sophisticated arguments, cherry-pick data, dismiss contradictory evidence, all while feeling completely rational. Munger was so aware of this that he made himself a rule. Before he could hold a strong opinion on anything, he had to be able to argue the opposing case as well as its strongest proponents. He called this steel manning, the opposite of a straw man argument. Instead of finding the weakest version of the opposing view to knock down, you find the strongest version, and only then do you decide. He said, "I never allow myself to have an opinion on anything that I don't know the other side's argument better than they do." This habit kept him out of more bad investments than any amount of financial analysis ever could, because the biggest risk isn't the market, it's you. Every choice you make has a hidden cost, and most people never think about it. This is the mental model of opportunity cost, and Munger used it every single day. The concept is simple. The true cost of any decision isn't just what you spend or lose, it's what you give up by not choosing the best alternative. When Munger considered an investment, he didn't just ask, "Is this good?" He asked, "Is this the best use of this capital right now?" Because money invested in something mediocre is money not invested in something exceptional. He applied this ferociously. Berkshire Hathaway holds an enormous amount of cash reserves, sometimes tens of billions of dollars, sitting idle. Critics say it's lazy capital. Munger said it was discipline. He was waiting for the exceptional opportunity, the one that justified pulling the trigger. He also applied this to time. Attending a meeting that produces nothing isn't free. It costs you the hour you could have spent reading, thinking, learning. This is why Munger was famous for saying no, not out of laziness, but out of the deep understanding that saying yes to one thing always means saying no to something else. Guard your yeses. They're more expensive than you think. In 1995, at a Harvard Law School speech that became legendary, Charlie Munger laid out what he called the psychology of human misjudgment, 25 cognitive biases that cause people to think irrationally. It remains one of the most important pieces of intellectual work in the history of investing. We can't cover all 25 today, but let's hit the most dangerous ones. First, reciprocation. We feel compelled to return favors. This is why salespeople give you free samples. Get something for free, and you feel obligated. Second, social proof. We look to others to determine correct behavior. In a financial bubble, everyone else is buying, so it must be safe, right? Wrong. Third, commitment and consistency. Once we've publicly committed to something, a position, a stock, a belief, we'll go to extraordinary lengths to remain consistent with it, even when the evidence says we should walk away. Fourth, liking. We're far more easily influenced by people we like, which is why advertising uses celebrities. and why financial fraudsters are almost always charming. The antidote to all of these? Awareness. Not perfection, just the habit of asking yourself, am I thinking clearly here, or is my brain running a program I didn't consciously choose? That question alone is worth a fortune. If you ask most people what made Charlie Munger wealthy, they'll say intelligence, or connections, or lucky stock picks. They're wrong. The single most important ingredient in his fortune was patience. Not the vague, feel-good kind of patience. The radical, almost painful kind that allows you to sit still while everyone around you is moving frenetically. Munger understood something about compounding that most investors never truly internalize, and I mean truly, in their bones. Compounding requires time, above all else. The longer you leave it alone, the more violently it grows. He and Buffett held shares in some of their greatest investments, Coca-Cola, American Express, See's Candies, for decades. Not years, decades. While markets crashed, while economic crises came and went, while pundits declared the sky was falling, they held. Munger once said the big money isn't made in the buying and the selling. It's made in the waiting. But here's what makes this hard. Patience feels passive. It feels like you're doing nothing. And in a world that rewards busyness, doing nothing feels wrong. That discomfort is the price of the ticket. Those who can pay it win. Before Charlie Munger, Warren Buffett was a disciple of Benjamin Graham, the godfather of value investing. Graham's philosophy was simple. Find businesses trading below their intrinsic value. Buy them cheap, sell them when they recover. Called it cigar butt investing, finding old, beaten-up businesses with one last puff left in them. It worked, but Munger saw something Graham had missed. Munger argued that a truly outstanding business, held for the very long term, will outperform a cheap, mediocre business every single time. Because a great business compounds its advantages. Its brand gets stronger. Its market position solidifies. Its competitive moat deepens. A cheap, mediocre business? It stays mediocre. He famously convinced Buffett to buy See's Candies in 1972 at a price that seemed expensive by Graham's standards. It turned out to be one of the most profitable investments in Berkshire's history. Munger's insight? It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. That one shift in thinking transformed Berkshire Hathaway from a good investment operation into one of the greatest in history. The lesson? Stop hunting for bargains. Start hunting for excellence. Imagine a medieval castle. The most important part isn't the walls or the towers or the soldiers. It's the moat, the body of water surrounding it that makes it incredibly difficult to attack. Munger and Buffett used this metaphor for business, and it became one of the most influential concepts in modern investing. An economic moat is a sustainable competitive advantage, something that protects a business from competition the way a moat protects a castle. There are several types. Brand moats, like Coca-Cola, where people will pay more simply because of the name on the label. Cost moats, like Amazon, where the sheer scale makes it impossible for competitors to match prices. Switching costs, like Microsoft Office, where the effort of moving to a competitor is so high that people just stay. Network effects, like Visa, where the more people who use it, the more valuable it becomes to everyone. Munger's approach was to find businesses with wide, deepening moats, and then hold them while the moat continued to widen. He wasn't interested in mediocre businesses temporarily trading cheaply. He wanted castles, surrounded by deep, growing moats, and then he wanted to own them, essentially forever. That's a very different game from what most investors are playing. Of all the deadly sins,
Munger said envy was the most stupid. Envy, he said, is the only one of the 7 deadly sins that doesn't even feel good. Greed feels good in the moment. Gluttony feels good. Even sloth has a certain appeal. But envy? Envy just hurts, and it distorts your thinking in ways that can cost you everything. During the dot-com bubble, rational investors watched their neighbors, colleagues, and friends get rich overnight on technology stocks. The pressure to join, to not miss out, was overwhelming. Many intelligent people abandoned their principles. They bought stocks they didn't understand. They paid prices they couldn't justify. They were making decisions not based on analysis, based on comparison.
Munger was immune to this, not because he had no ego, but because he had a clear internal definition of success. He was measuring himself against his own standards, not against anyone else's scorecard. This matters more than most people realize. The market is specifically designed, through media, through conversations, through social proof, to make you feel like you're always missing out. The antidote isn't to stop caring. It's to define what winning actually looks like for you. Then, stop looking sideways. Here's a mental model from economics and physics that Munger applied relentlessly to investing: the principle of scale. In many industries, getting bigger makes you disproportionately more powerful, not linearly more powerful, exponentially. Consider a supermarket chain. When you operate one store, your advertising covers one location. When you operate 500 stores, that same advertising campaign reaches 500 times the customers at essentially no extra cost per customer. The advertising becomes dramatically more efficient at scale. Manufacturing works the same way. Fixed costs get spread over more units. Research and development investments pay off across a bigger customer base. Supplier relationships improve. Distribution networks become more efficient. Munger studied this deeply. He understood that businesses with structural scale advantages tend to get stronger over time, not weaker. Their competitive position isn't eroding, it's deepening. This is why Berkshire invested so heavily in businesses like Geico. Insurance is a scale game. The larger your customer base, the better your risk data. The lower your costs, the more competitive your pricing. When evaluating any business, Munger asked, does getting bigger make this better? If the answer was yes, and the business was already on that trajectory, that was a very compelling reason to invest. If you asked Charlie Munger what the single most important habit of his life was, he would not say investing. He would not say discipline or patience. He would say reading. In my whole life, he said, I have known no wise people who didn't read all the time. None. Zero. Munger read for hours every single day, well into his 90s. Not finance newsletters, not stock reports. Books, history, science, biography, psychology, mathematics. He was a genuine polymath, someone who pursued mastery across multiple disciplines simultaneously. He did this because he understood something that most people miss. The biggest competitive advantages in investing don't come from working harder. They come from thinking differently. And you can only think differently if you're constantly exposing yourself to new frameworks, new perspectives, new ways of seeing old problems. He also had a concept he called going to bed smarter than when you woke up. Not dramatically smarter, just a little. Compound that small daily improvement over 50 years, and the result is a mind of extraordinary capability. The good news? You don't need his IQ. You just need his habits. Read more. Read broadly. Never stop. There's a quote attributed to Jim Rohn that Munger's entire life embodied. We must all suffer one of two things: the pain of discipline or the pain of regret. Munger chose discipline. every single time. Think about the decisions that built his fortune. Passing on hundreds of investments that were merely good because they weren't exceptional. Sitting with cash and waiting, sometimes for years, for the right opportunity. Never borrowing money to invest. Never chasing performance. Never panicking during crashes. Each of those decisions required discipline. Real, grinding, uncomfortable discipline. The kind that feels wrong in the moment because everyone else is doing the opposite. But Munger understood the asymmetry. The pain of discipline is temporary. You decline the trade, you feel frustrated for a day. The opportunity passes, and you move on. The pain of regret, that can last forever. A single catastrophic decision made impulsively, greedily, fearfully, can erase decades of progress. Munger guarded against catastrophic mistakes above all else. Not because he was afraid, because he understood the mathematics. A 50% loss requires a 100% gain just to break even. Protect the downside. The upside takes care of itself. Charlie Munger passed away in November 2023, just weeks before his 100th birthday. He left behind a fortune estimated at over $2 billion. But here's the thing about Munger's legacy that gets missed in every obituary. The money was almost incidental. What he actually left behind was a way of thinking, a system so carefully constructed, so rigorously tested over decades, that it changed the way thousands of investors, thinkers, and leaders approach problems. His speeches, particularly The Psychology of Human Misjudgment and The Art of Stock Picking, have been studied by some of the most successful people in finance. Warren Buffett has said repeatedly that Munger made him a better investor, a better businessman, and a better person. His books, his letters, his shareholder meeting answers are studied like scripture by serious investors around the world. And the most extraordinary part? He gave almost all of it away for free. His greatest ideas were public. His speeches were recorded and distributed. He wrote no subscription newsletter. He charged no course fee. He simply believed that good ideas should be shared. In that sense, he was the ultimate long-term thinker, more interested in the impact of his ideas than in their monetary value. That tells you everything you need to know about the man. We've covered a lot of ground today. Inversion, the circle of competence, the Lollapalooza effect, incentives, opportunity cost, patience, moats, envy, scale, reading. 20 minutes, 20 mental models, one extraordinary man's life. But let me leave you with the most important thing Munger ever said about learning, because it applies directly to you right now, watching this. He said, knowing the right thing and not doing it is the same as not knowing it at all. Information without action is entertainment. And I want this to be more than entertainment for you. So here's your one action step from today. Pick one mental model from this video, just one, and apply it this week. Use inversion on a decision you're facing. Identify where you're outside your circle of competence. Ask yourself about the incentive structure in a situation you're dealing with. One model, applied once. That's how this starts. And if you found value in today's video, please subscribe, because we're just getting started. There are dozens more mental models to explore, more extraordinary thinkers to unpack, and more of these insights to bring to you. I'll see you in the next one. Thanks for watching.